pitch, I wanted to start with a very similar theme. We've been up here about 4 years now, at least since the kind of current management team has come over post GCAS's acquisition. And we've really said very similar things. In 2016, we highlighted that there was a lot of structural issues. It wasn't just cyclical. Similarly, in 2017, after the grounding of the 225, that lifecycle management was a tremendous problem in the industry, that investment and support by the value chain was going to be needed to transition the assets. 2018, we debated whether helicopters were even a financeable asset, whether residual values were defensible given a lot of the market dynamics we see, OEM preference, end user preference to change aircraft as frequently as they do, the tremendous variability in configurations, and the oncoming consolidation in space. We highlighted the damage to the industry that as capital providers went through these Chapter 11s, capital flight would ensue. And in 2019, we described what's the new normal. The new normal is replacement level demand, transition to modern types at a very tepid pace, and frankly, capital needing to be deployed in spaces that are not what we traditionally think of. MRO, support, different support models. We also tend to start out with a view on the macro market in general. Our partners, Baker Hughes, at least for the time being, they're in the process of being spun out, continue to provide us data. I'm always very hesitant to talk to a forecast that goes out to 2092, but bear with me. And I'll also caveat, oil and gas forecasts tend to be incredibly optimistic. I think the term I heard on airline forecasts is their supply forecast. You're selling a product, so you never really want to forecast too conservatively. But what we've seen consistently in the last 10 years is the outlook for macro oil demand is shifting. Whether it's ESG, the push towards sustainability, the change in the just fundamental outlook in oil is shifting year by year. And these are not, this isn't Greenpeace forecast. This is BP, Rystad, IEA. These are the people whose business it is to know what is happening to long-term demand. And the current consensus is that sometime in the next 2 decades, the growth rate on oil, which has been consistent at roughly 2% CAGR for the last 40 years, 50 years, will shift and we will see a peak in the demand for oil. Now that doesn't mean that we won't need oil. That doesn't mean that it won't be a part of the energy value chain, that there won't be significant investment required to backfill declining reserves. But the bottom line is this is just not a market where we can bank on growth forever. So what does that mean for offshore? 2019 was actually a good year for offshore. The reckoning in shale, not being able to return on its capital promises, finally took place. And we saw capital flight in the shale industry similar to what we saw in the helicopter industry and other parts of our market. The bottom line is if you're not hitting hurdle rates, you're not bringing cash flow back to investors, you are not getting money in oil and gas. This is not a market where capital is abundant. It is not popular to lend in oil and gas. So if you are not beating your returns, it's gone. Offshore took an interesting path in the last 4 years. It was painful, but we consolidated. Offshore rigs have been scrapped. Helicopters have been consolidated, which we'll speak to in a bit. But the projects that are being greenlit on economics that are actually achievable. And that has changed the flow of capital in between onshore and offshore to our advantage to replace declining reserves. And we have seen a recovery in new tenders. We've seen a recovery in project greenlights. Much different outlook than we had probably 3-4 years ago, where shale was going to be 100% of new capital for oil and gas going forward due to some fairly lofty expectations on what kind of cost per barrel they would inevitably achieve. But I want to emphasize, consolidation has saved offshore. It hasn't been growth, it hasn't been a return to optimism, it has been a scrapping of platforms, a scrapping of rigs, and ultimately a transition down to a supply level that makes sense. So what does that mean for helicopters? Well, we've actually had some pretty good consolidation ourselves. We showed last year that the transition of the 225 out of the heavy and super medium space has been a consolidating factor that's allowed the market to feel somewhat healthy. Right? We believe today that the heavy super medium market is roughly 90% utilized on a 1,000 hour per airframe basis. Now, that's 90% utilized out of a global fleet of roughly 350 units, 300-ish units. So there's probably still 30, 40 units still out there, and you can still squeeze some more utilization out of the existing fleet. So this is by no means problem solved, but it's getting better. We've seen sustained offshore rig counts for the first time since 2016. It does feel like a solvable problem. In 2016, when oversupply was 2x the fleet size, this was not a solvable problem. This was a no bottom in sight conversation. So looking forward, Milestone's a bunch of investors. We have a $5 billion book. We put $1 billion out every year for the last 4 years through the downturn. We diversified our book from nearly 85% oil and gas to only about 55% oil and gas. We've transitioned 50 to 70 aircraft per year or placed new aircraft. We've taken significant orders from OEMs. This is not a space where we're sitting and packing up and just putting our head in the sand. We've spent tremendous amounts of money to try and make the space viable for our existing book and on a go-forward basis. So when we look out, we do see some factors that are optimistic from the standpoint of investment that is required. While we have a very flat demand outlook that aligns to some of the other presentations we heard this morning, we do see an aging and attriting fleet. The oldest aircraft in the heavy super medium fleet today are flying the most flight hours because they're the cheapest. They're the ones that were originally bought. Non-traditional financing really didn't enter the space until the 2009, 2010 period, and really only got to scale in 2011. But before that, they were owned traditionally by the operators. So they're naturally the cheapest aircraft. They're the ones that have been marked down the most through Chapter 11s. They're the ones flying the most. However, we now have young machines, young 92s, approaching 30,000 flight hours, which there's an hour's limit on the airframe. Those aircraft will have to have something done to them that is not continued flying outside of some changes to the type certificate. So what do we see going forward? We do see a capacity call, or a call for new capacity, over the next 2 years. But where we step back and want to have a conversation more broadly with the industry is how do we respond to that? We see 4 different types today vying for a space that is roughly 300 units. There are some additional markets where those aircraft can service, but by and large, the history of the big aircraft space has been in offshore. So if we have a 300 unit market with roughly 20 aircraft attriting per year going forward, that's just the number of heavy aircraft that are becoming roughly 15 to 17 years old, which tends to be about the time that they're less attractive to end users. What do we do? How do we respond? And our view is that uniformly financing every machine is forgetful to how we got here, hence the title of the presentation. We have to remember that this cycle we've gone through, the pain that financiers have felt, that OEMs have felt, that the operating community has felt, was due to a complete mispricing of the risk in the asset class. And the risk in the asset class is fairly straightforward. If there are not enough missions, enough flight hours to service the aircraft, if it is not easy to mod and transition, if the contract terms that are backstopping that origination are not sufficient, the investment is foolhardy. So what we would ask the space to consider is how do we introduce new capacity? Right? We're excited about the prospect for investment. None of us like to come up here and talk about consolidation. We want growth. Everyone loves growth. But until there's a proper risk share among the value chain, until there is scale support across the fleet, meaning we can't have onesie-twosie fleets, different types in different locations with no infrastructure to get spares, without training, without proper provisioning of support equipment, this will become a niche space and continue to be a niche space. And that's not a financeable space, at least not financeable in the terms that we've historically underwritten these aircraft in. So I cut some of this because these screens are quite a bit smaller than the venue that we normally use for this conference, but that one didn't make it up here evidently. So what this shows is today, if you go ask an appraiser for a super medium appraisal curve, a forward value projection, it looks like exactly what a 92 curve looked like a few years back, what a 225 curve looked like a few years back, what a 139 curve looked like. It says that the aircraft is worth roughly 50% of its original value, 15 to 20 years from the date of delivery. That's fine. That historically has been accurate. 412s, Super Pumas, legacy aircraft absolutely perform to that model. But what we've seen with the introduction of new technology, with an oversupplied market, is that the aircraft actually have an accelerated depreciation potential, primarily driven by preference by the end users, by entities that just want to change types. And it's not always old for new. We have seen only in the last 24 months people asking to retender brand new super mediums for new super mediums, which, I'm sorry, but that just makes you want to pack up your toys and go home. So if you're going to ask us to do a 1% lease rate factor, which today is still not market, on an aircraft that you want to then replace at 10, 15 years, where there's not a viable secondary market, where there's not support, where there's not authorizations of the MRO network to bring it into that mission, it is not a financeable model. So how do we change that? Well, we can price higher, and we certainly have. New money for, I believe, any of the financiers in this space is certainly something that is looked at with quite a bit more scrutiny than it was in the past. But we can also mitigate. This is something where the industry needs to come together because it's absolutely a core service. If there is commitment by the end users for better contract terms, which we're encouraged by some of the things we're hearing, some of the end users. If the OEMs do come together on supporting lifecycle management of legacy types, by provisioning alternative support models for old types, by giving STCs and licenses for the support of aircraft into other missions, these become solvable problems. The financeable model returns to something that we're much more familiar with. So I'm going to echo what we said last year. If I had $1 to deploy today, I'm probably not buying a new machine. I'm probably putting into some type of support model, because ultimately the financeable model for the industry is tied to our ability to get 30 years of economic life out of the asset. The aircraft is absolutely designed for 30 years of economic life. It should not die after 10 years or 15 years or whenever the end user or operator decides it's time to get something shiny and new, which we love. We absolutely support new technology. It just has to make sense financially. So the three areas we talk about for new capital deployment, we would say it's alternative support models, which we would say is, an OEM PBH may not be the right answer forever. There's an abundance of S76s out there with a lot of green time on them. It doesn't make a lot of sense to buy new 76 parts. There should be solutions that are developed that help us harvest that inventory, right-size the fleet. It's supportive for the introduction of new technology. It's supportive for creating new missions at lower operating costs. But that takes partnership. It takes investment. On the MRO side, we still see far too few providers of support. I'll credit Bell here. I'm a former Bell engineer at one point. Bell has a very different support model. You can get Bell support anywhere. But for the types that are largely in demand in the markets where the most capital is being deployed, the support models are very different. It is not as open of a network. And to facilitate the life cycle transitions that you would see on other types, you have to have a much different approach to how various entities are allowed to support the types in the form of authorizations, in the form of STC allowances, in the form of licenses. And frankly, we just don't see it today. The MRO space, through the downturn, has absolutely shrunk. Operators have largely leaned out their MRO space or their MRO capacity as they've gone through Chapter 11s. We've seen entities that were large players in space like Vector consolidate its approach to the market. So these are spaces where the market needs more services, not less, and yet we don't see the trends that you would need to actually, once again, make the asset class more investable. And finally, lifecycle management. We've stood up here for 4 years, 5 years now, saying that lifecycle management was a dirty word in this industry, that you had to have a path to taking the aircraft through multiple missions, multiple transitions, standardized configurations, easy mods, to make it a financeable asset. Otherwise, the investment case is destroyed after the first economic use. And so we still push for that. At Milestone, and we don't just go up here and talk, we have spent hundreds of millions of dollars on inventory purchases, on mods, transitions, developing whole new markets. We've deployed our 225 fleet into a market that never used 225s before. Shout out to the OEM and to the operators who have taken that risk, but it's a good news story in a space that 2 or 3 years ago, everyone just kind of wanted to throw their hands up and say, this can't be solved. So these are solvable problems. They're investable problems. They're lucrative returns when done properly. But it needs to be done, and the scale of it needs to be applied across many more types. So what is the truth? The point of these speeches, I think, is to get the investor community, the OEM community, the operator community, and the end users aligned to one outlook, right? The sooner we all have a very unified view of the future, the sooner capital moves at scale, the sooner that solutions move at scale, the sooner that this is a space that makes sense. Oil markets aren't going to stop being volatile, right? Everyone stood up here and hasn't mentioned that we have a massive demand impact occurring that is impacting not just our market, but frankly, the global supply chains and demand for oil across the world. And we'll see how it plays out. It's too soon to prognosticate, but it's a tremendous event that's occurring globally right now. We truly believe in replacement level demand. We think that whether it's offshore investments or helicopters, that people not benchmarking demand to replacement level numbers are going to overestimate, and we don't want to repeat the mistakes of the past at another supply bubble. We think to create value and maintain returns, especially as a financier, you have to have scale and you have to be an asset manager. This is not a space for the foolhardy to enter and take their aircraft back in Chapter 11 and then figure out what asset management means. This has to be a space where you're committing capital speculatively to MRO, to having relationships and inventory on hand, to being willing to sit on a machine for extended periods of time and do the right thing to preserve the value of the asset. And despite Chapter 11's occurring and consolidation occurring, which are things that make sense for how the cycle is played out, we agree with LCI's comments this morning that revenue is ultimately what is needed in this space. The reflation of revenue, which absolutely changed the economics of this market. We'll echo again, people want to invest in support solutions, invest in transitions, invest in inventory solutions. Ultimately, if we create the value change for the machines, the investments will be superior, and we'll be happy with what we bought again. And I would just once again make a call for scale. We have a lot of aircraft types, a lot of opportunities for new types to enter, but it is a finite market, and none of these things make sense if you have a fleet of 30 or 50 machines that doesn't have the proper heft to justify capital, to justify spare parts provisions, to justify training, investment from the various stakeholders in the market. So I would say that we all need to have a conversation of just what is the right solutions, what is the scale solutions to make these assets investable. But, thank you for the time. We don't like to get up here and be too negative. We love the space. We're obviously spending tremendous amounts of money, but we think this is just the forum where we all have to get aligned. So thank you so much, and open up for questions.
You can't go cheery in the last 30 seconds. Do we have any questions? You made the argument for MRO last year and support. Why aren't people investing in that sector?
I think it's an investment that takes a lot of risk, because today OEM partnerships that are often needed to make that investment bear fruit are not a clear path, and certainly not one that is desirable to enter into without a certain amount of relationship or scale with those OEMs. You need licenses, you need STCs, it's effectively asking for other people to be able to do things. So it's a risky investment, but it's necessary.
Any other question? If you're just expecting replacement level demand, is that enough to sustain the same number of OEMs?
Oh, it's certainly enough to sustain the same number of OEMs. The OEMs have dynamic businesses diversified across any number of verticals, including military. Does it mean the market may consolidate some of their product lines? Perhaps. There's certainly a history of that in the space. That doesn't necessarily take OEMs being eliminated from the space.
Question at the back.
Hi, Cory. It's Dave Martin from Sikorsky.
I did.
Hey, I'm just asking if you could expand a little more when you talk about MRO investment. Where do you see the gaps in the MRO space now, and where do you see the potential to improve on that?
So I'll give an example with the 225. When the 225 went down, it was predominantly a market that was supporting offshore and search and rescue. There was a military support market as well, but a lot of that capability doesn't cross over from a certification basis. And so what we found when we started prospecting for new missions was that there was no inventory or supply chain of components that would be needed to do some of the missions we found the aircraft to be viable. For instance, heavy hooks, blade fold kits, things that we leaned forward very early and very aggressively, and with the support of the OEM we're able to solve, but it was not cheap, and it took tremendous investment. As I look at a market that has a 76 oversupply issue with an aircraft that is predominantly oil and gas based, or other aircraft that are kind of in their similar phase of life cycle, legacy machines, those supply chains and those kind of OEM approaches to the market are still very much geared towards that original primary mission. And the sooner that there is an open-mindedness towards how do we do something else, I think we will actually start to see a chew through in some of this oversupply. So I don't know if that answers the question perfectly, but that's our view.
Any more questions? Brilliant, thanks.